Hi, so welcome to the stream today and welcome to our final episode in our IFRS masterclass focusing on IAS 33 earnings per share. In the first episode, we looked at the diluted earnings per share issues, discussing the basic principles that we need to understand when it comes to the share options. We went to the issue in relation to the convertible loan notes and then discussed the principles using some very simple questions. Then in the episode 2 or in the second episode, we then focus on solving a fully fledged examinable question in respect of calculating the diluted earnings per share when we have the share options and the share and the convertible loan notes. Then we also spoke about the issue in respect of the earnings, the right issue. So when an entity makes a right issue, how do we calculate the basic earnings per share? In case you miss any of these, you can check the channel on the playlist, or you can check the playlist on the channel under the IFRS Masterclass podcast. You will see episode 1, episode 2 of the IAS 33 lecture, so you can watch the full lecture there. Today, we want to wrap up quickly on IAS 33, looking at how we calculate the basic earnings per share, taking into consideration bonus issue and then issue at full market price. So when an entity makes a bonus issue, or when we are supposed to calculate the earnings per share and in the question there is a bonus issue, what are we supposed to do? How are we supposed to deal with that? Also, when an entity makes an issue at full market price during the year, how do we deal with that generally at the end of the day? So you are welcome to the stream today. I see some of you guys joining. Give us a thumbs up on the video. It really helps us a lot to get the video to reach as many students as possible. Most importantly, make sure you share the video. Let's reach many students to get access to this content. Let me also hear from you in the comment section. Any questions you have for me, something that you would want me to share my thought on the stream as we continue in the discussion. So some few announcements quickly in respect of what the ICA is doing going into the future. And the first thing is certainly going to be the issue about give me a sec. It's like my iPad is not connected properly. There we go. So the first thing is going to be the examination. So registration for the March 2024 examination, it's going to be commencing on the 22nd of January and will be closing on 16th of February 2024. As always, we have 3 centers in Accra. So ICAG College, the Zenith College, and then the UPS, the Accra College of Education near UPSA. So these are the 3 centers in Accra. And in Kumasi, there are 2 centers there. And other regions, the regional capital, we have centers. IC has centers there. Tema, there's a center there. If you happen to be in Liberia, then definitely the capital of Liberia, Monrovia, you will be able to get access and write your exam there. To register, you know that already. You go to your student portal, that is the sms.icag.com, and you'll be able to do your registration when the registration ultimately opened. Most importantly will be the examination fee. Level 1 bump up a little bit to 86, level 2 505, level 3 530 Ghana cedi per paper. The examination is going to be taking place between 4th of March 2024 and 18th of March 2024. So these are the few things you need to take into consideration when it comes to the examination. For the timetable of the exam, it's going to be the same issues that you know already. We are going to be sharing that with you as well. If there are any questions you have in respect of the examination, or there is any challenge that you have, as you can see on the flyer here, you can contact the ICAG and you will be assisted in respect of what you have to do to help you to register for the examination. So the examination is going to be opening and you want to make sure that you are able to do that and register for the exam. So it tells you that the exam is here. Immediately the registration is opening, it means the exam is here. And so technically today is 19th, so tomorrow 20th, Sunday, so Monday registration has started. And when registration starts, it means boom, we are ready to go into the exam hall and then go and write the exam. So you want to make sure that you pay attention to that very well. Then the last thing is going to be the syllabus launched. You know that the Current syllabus will be expiring this year, and so the last examination under the current syllabus will be the July 2024 examination. So the new syllabus, which is going to be effective, the first exam of that is going to be in November 2024, will be launched on Monday 29th of July 2024, 2 p.m. UPSA. So it tells you also that in case you are still on the edge, trying to delay, trying to wait, the new syllabus is coming in. There are a lot of beautiful things in the syllabus, various updates in the syllabus to various subjects, and you're going to love it. But we're going to talk about that after the launch of the syllabus, because that would be very prudent to do. So after the launch of the syllabus, the various things that we have to take into consideration and know about going into the future, we will be discussing that to help you, so you can decide whether you want to wait till that syllabus becomes effective in November, or you want to take some actions in March and July and see if you can become a chartered accountant as soon as possible. So that is basically what you must understand about the examination and the syllabus launch as well. Now, so let's come into our discussion and then begin the discussion for the day. So we are still on IAS 33, earnings per share, okay, as a basic issue. And as you heard in my introduction, we've looked at the diluted earnings per share discussion in episode 1 and episode 2. We've looked at the right issue, how we calculate the earnings per share when there is a right issue. So now we want to go into bonus issue. So when there is bonus issue, how do we calculate the basic earnings per share? So that is where we want to start the journey from today. So bonus issue. Now, bonus issue simply refers to the issue of free shares to equity shareholders. That's all. Issue of free shares, technically, to equity shareholders. That's what we mean by bonus issue. So what does that mean in principle or in practice? It means that we are converting reserves into share capital. That's all. Reserves are being converted into share capital, and this is very common when an entity is seeking to increase its stated capital. They can convert reserve into share capital, especially when the banking sector cleanup and recapitalization was done here in Ghana, raising the minimum capital from 120 million to 400 million Ghana cedi. What happened was that many of the banks didn't have to inject new cash to help them move from the significant cash to help them move from the 120 million to 400 million. All they had to do was to convert their reserves into the share capital so that they can meet the capital requirements, and the Bank of Ghana gave an approval for that. So certainly it's something that is common. So it means we are just giving ordinary shareholders more shares, but they are not paying anything for it. Unlike right issue, where they're going to pay below the prevailing average share price of the shares, in bonus issue they are getting new shares, but they're not going to pay anything for it. Now, because it is a free share that we are giving to them, it means that anytime there is a bonus issue, we would have to calculate the bonus fraction. Again, so you realize that for the second time, bonus fraction is coming into the picture. When there is right issue, we calculate bonus fraction, and you saw the way we calculate the bonus fraction under the right issue. Anytime an entity undertakes a bonus issue also, we are going to be calculating the bonus fraction. So how do we calculate the bonus fraction when there is a bonus issue? The formula is pretty simple. It's going to be the number of shares after the bonus issue divided by the number of shares before the issue. Okay? Number of shares after the issue divided by number of shares before the issue. What does that mean? Let's give an example. So let's say that, we are told that an entity makes we are told that an entity makes a 2 for 5 shares bonus issue. What does that mean? Like I told you, under the retained earnings, 2 for 5 means we give you 2 new shares for every 5 that you are having now, existing or current. Does that make sense? So 2 for 5 means that we give you 2 new shares for every 5 that you are having in that case. So the question we then ask ourselves is, how do we calculate the bonus fraction? Stay with me. The numerator, is the number of shares after the issue. So if they did a bonus issue of 2 for 5, that means after the issue, each shareholder will be having how many shares? 7. So our bonus fraction, it's going to be 7 divided by the number of shares before the issue. How many shares were they having before we did the issue? Existing, which is 5. So our bonus fraction becomes 7 over 5. So when an entity makes a bonus issue and we are calculating the basic earnings per share, this is how we go by calculating the bonus fraction. And like we discussed under the right issue, the bonus fraction will only affect shares prior to the right issue. So the same principle applies here. Bonus fraction affect shares prior to the right issue. So the total number of shares after the right issue will not be affected by the bonus fraction. Only the number of shares existing prior to the right issue will be affected. That is the idea about bonus issue. Very simple. So let me bring up a very simple question as well, as it is simple, and then let's see what we can do. Now I'm taking this question from my book in financial reporting or corporate reporting. If you have my book, this is page 302 of the book, but you can also take a screenshot of it here. So what do we have? Let's see. So let's see a very simple illustration here. The requirement here is very simple. It says calculate. Let's zoom that out a little bit so that you can see it well. Calculate the earnings per share for the year ended 31st September 2020. OMG Limited has the following information. Profit after tax has been given to us to be 400,000. Outstanding shares 40,000. Pretty simple in this particular regard. On 1st April 2020, now stay with me, 1st April 2020, this should be 30th September. On 1st April 2020, the entity made a bonus issue of 2 for 1. Okay, so let's crunch some numbers quickly. OMG Limited. Let's see what we got for OMG Limited. So, few things quickly. They made a bonus issue on 1st April 2020. So, stay with me. If the year ends on 30th September, that means the year will start from where? 1st October. So, from 1st October 2019 to 31st March 2020. That is how long? October, November, December, January, February, March. That is 6 months. So for 6 months, they were having the outstanding share of 40,000. Now remember, the nominal value of the share is $1. So it means the number of shares will still be 1. If it was 0 point something or something like that, it would have divided. But 40,000 divided by 1 is still going to be 40,000. So no cause for alarm in respect of that, right? So for the 6 months, we had 40,000 shares outstanding. Then now from 1st April, when they did the right issue, 2020, to the year ended 30th Sep 2020, I think that will also be another 6 months. So we bring that up, and that is another 6 months. Now, how many shares will be coming? Stay with me. They said they did a right issue of 2 for 3. So we give you 2 new shares for every 3 that you are already having as a shareholder. All right? We give you 2 for every 3 that you are having as a shareholder. So what does that mean? So bonus issue, it's going to be 2 over 3 times the number of shares outstanding, 40,000. So we punch that out. What do we have? 2 over 3 by 40,000. And I'm getting 26,667. So now it means from the 1st April to the 30th September 2020, the total shares now will be the bonus issue plus the outstanding shares. So giving us a total of 66,667. So it means for the second 6 months, or the final 6 months for the year, we are having 66,667 shares outstanding. Does that make sense? That's very important. So that's the starting point. Now, because it's a bonus issue, before we can calculate the weighted average number of equity shares, we need to calculate the bonus fraction. So our bonus fraction, if you remember, we said the bonus fraction is the number of shares after the issue divided by the number of shares before the issue. Now, since the right issue, since the bonus issue was 2 for 3, that means after the issue you now have 5. So it's gonna be 5 over the existing 3. That's our bonus fraction. And like I told you under right issue, and we won't punch this out, because when you punch this out, you have to approximate it, and you are going to be working in decimals. So you want to leave the answer like this, because we're going to work for it later on. So now that we have our bonus fraction, we have the shares, we have the number of periods, we can then calculate the weighted average number of equity shares. So we bring in the period, if you want. We bring in the outstanding shares. We bring in the bonus fraction. We bring in the timing ratio. Then we get the average coming up. Sounds good? There we go. Give me a sec. Let's see if I can bring my slide a little bit up like this. Let us go up a little bit. Okay, so let's go. Let's zoom back out. So the period, we have the period here. So I'm just going to copy it, as you know already, as a lazy boy. Just going to copy it, and then I'll make it a little bit smaller just to fit into my slide. All right, something like that. All right, so the outstanding share for the first period, we said is 40,000. The outstanding shares for the second period, 66,667. Then the bonus fraction will come, which is 5 over 3 here. Okay, 5 over 3. Then the timing ratio, 6 over 12. Bonus fraction will not affect shares after the bonus issue. Okay, that is why we said the bonus fraction affects only shares prior to the right issue. So after the right issue, the bonus fraction will not come in. Timing ratio 6 over 12. So we multiply up. Remember, we are multiplying everything. That is what is giving us the average. So we multiply up 5 over 3 by 6 over 12 by 40,000. Let's see what we got. 33,333. Okay, then we look at the second one, 6 over 12 multiplied by 66,667, and that is probably 33,334 approximately. So we can then add the two up, and that gives us the weighted average number of equity shares. Weighted average number of equity shares. So 33,333 plus 33,334, and that is 66,667. Okay, 66,667. Now, like I tell you always, don't get any ideas and say, oh, if that is the case, it means that the total share after the issue will always be the weighted average number of equity shares. No. No. This is just a coincidence. It may not happen all the time. So you pay attention to the concept and the way we do the calculation. So now that we have this, we can calculate our basic earnings per share. So our basic earnings per share will be our profit after tax divided by our weighted average number of equity shares. And we can work that out. Profit is $400,000. The weighted average number of equity shares we just calculated, 66,667 shares. So we punch that out to get our answer for the period. Let's see what we got. 400, 1, 2, 3, divided by 66,667. So I'm getting 5.9, probably $6. Probably $6. Because it's 5.9997, so we can run and make it just $6 in that particular case. So that is how we deal with bonus fraction. Now, usually, that's how we deal with bonus issue. Usually, when the bonus issue occurs at the beginning of the year, then there will be no need for us to do any timing ratio thing. So if the bonus issue occurs at the beginning of the year, all we would do is that, because usually if there is no date in the question, the assumption for bonus issue is that it will be done at the beginning of the year. That's the assumption. So if it is done at the beginning of the year, so when the bonus issue is done at the start of the year, then your weighted average number of equity shares would just be the outstanding shares plus the issue in respect of the bonus issue that we had. That's all. So if the bonus issue was done at the beginning of the year, no problem. You don't have to come and do any of these issues coming in, because we are just going to be assuming usually that it is occurring at the beginning of the year, and so we will not apply the timing ratio in that particular case. And as we move ahead and solve some questions, you're going to see how this actually plays out. But that is all about the bonus issue. Very sweet, simple, straight to the point. So like I keep on telling you, it's all about the principles. When there is right issue, we have to calculate bonus issue. And if you remember, under right issue, the bonus issue is the current share price divided by the X right price. And the X right price, you have to calculate for that. But when there is a bonus issue, all you have to do is the number of shares after the issue divided by the number of shares before the issue. And that gives you the bonus fraction. And the bonus fraction affects only shares prior to the right issue. The bonus fraction affects only shares prior to the right issues. Okay, so that's the idea about that. So let's get a final part, which is going to be issue at full market price. The final thing. Issue at full market price. So this is like issue of new shares generally. Okay, so if we issue new shares to the public, no problem. Okay, so get the idea. Bonus issue, it is to existing shareholders. They don't pay anything for it. Right issue, it is to existing shareholders, but they will pay something below the current share price. But issue at full market price is a public issue. Are you getting it? So here we are issuing shares and everybody can buy it, whether you're an existing shareholder, you want to buy more, or you are coming in and you are not an existing shareholder. But the key word here is that you're going to pay the full price for it. If we are issuing it at $10, you pay the $10, and that is the current share price that may prevail there. So issue at full market price. What do we do? Here it's pretty going to be simple. Definitely the issue is going to be calculating your wins. And so you're going to be considering the timing ratio, and then you'll be able to then calculate your wins and get your answer coming in. So probably let me give you a one-liner here before we come. So it refers to the issue of new shares to the public at the prevailing share price of the entity. That's all. So it's one of the simplest areas that we can actually start our discussion from generally when it comes to dealing with this whole issue about this. Okay, so let me bring up a very simple illustrative question again for us to see how we do this calculation. Very, very simple here. I'm gonna come in with this. Okay, now so the way we calculate the weighted average number of equity shares will be bringing the outstanding shares. How long has that been in existence? Because the timing ratio will always come into being if the thing is not occurring at the beginning of the year. Okay, if it is occurring at the beginning of the year, then there will not be any timing ratio. But if it is occurring midway or within the year, then certainly timing ratio has to come in. Okay, timing ratio has to come in. So we bring in a timing ratio. So let's use this question as a guinea pig to bring out the principle. Calculate the earnings per share if the profit for the year ended 31st October 2020 is $100,000. $100,000. So what do we have? My Love Limited had 10,000 2.5 shares at the beginning of the year. It issued 4,000 shares at 4.25 per share on 1st March 2020. Okay, so this is a full market price situation, and so you know what you're supposed to do already, and so let's go straight up into it. So if the year ends on 31st October, then it starts on 1st November. So from 1st November 2019 to they did the issue on 1st March, so that means 28th of February 2020. That'll be how long? And then how many shares were outstanding? 10,000 shares were there. Now, so November, December, January, February, that's 4 months. Okay, so that has been there for 4 months. Then from 1st March 2020 to 31st October 2020, now they did a full issue of 4,000 shares. So now the total number of shares will be 14,000, and that had been there for 8 months. Are you getting the idea? So that is the idea about that. So once we have this, it's issued at full market price, so there will be no bonus fraction headache here. So all we do straight up is to calculate the weighted average number of equity shares. So let me just copy this. Let me copy this. I will clean some of the things there, then we'll just use it. There we go. So I don't need bonus fractions, so I'm just gonna clean that. Then I will just rearrange something like that. Okay, let me bring this in like this. Now let me copy my period above from the top there. Then we can paste, make it a little bit smaller, give it a little bit space. Okay, just trying to do some lazy boy job here. Okay, so for the first period, number of shares outstanding, it's 10,000. Timing ratio 4/12. Second period 14,000. Timing ratio 8/12. So we multiply up to get the average. Okay, so 4 divided by 12 times 10,000. That's 333. All right, then the next one, 8 divided by 12 times 14,000, and that is 9333. And so that gives us our weighted average number of equity shares. So 3333 plus 9333, and that gives us 12,666 shares. 12,666 shares. So issue at full market price, that's how we calculate our weighted average number of equity shares. But that's not what the examiner said we should do, right? The examiner said we should calculate the earnings per share for the entity, the basic earnings per share, what is happening currently, and that'll be the profit of $100,000. So $100,000 divided by the weighted average number of equity shares, 12,666 shares. So we divide that, and that gives us the basic earnings per share. And I'm getting $7.9 approximately. So that is the idea about issue at full market price as well, and what we do in respect of that. Very sweet, simple, straight to the point. So these are the fundamental principles that we need to understand. So in a given question, fundamentally, if it is issue at full market price, you must know the principle. If it is dealing with the issue in respect of bonus issue, you must remember the principle. If it is right issue in the question, you must remember the principle, because these three guys are basic earnings per share. Then we go to the diluted earnings per share, and the diluted earnings per share, if it is share options, you must remember the principle. If it is dealing with convertible loan notes, you must remember the principle. So these are the broader principles that we must understand when it comes to dealing with calculating earnings per share. Now, on the extreme end, it's where we sort of take this to another level, and that is where we try to find out a reversal and split of shares, so share price, because sometimes an entity will decide to do what we call, so there is bonus shares or bonus issue. There is right issue, and then there is stock split. Now, look at the difference here. Bonus issue, we are converting, like we said, we are converting reserves into share capital. So technically, shareholders are not paying anything. So what happens in bonus issue is that no money is coming into the business, but the number of shares are going up. Okay. In right issue, what is happening is that shareholders are paying some money, but the money they are paying will be lower than how much they should have paid. So some money is coming in and the number of shares is also going up. In stock split, it's a strategy that the entity undertakes where the share price is splitted. Okay, the nominal value of the shares is divided so that the number of shares go up. So in stock split, it's not that the entity is issuing new shares. It's not that people are buying anything. The entity just wants to increase the number of shares in issue. So when an entity wants to increase the number of shares in issue, then they can undertake what? A stock split. That is the extreme angle, and that will affect the number of shares in issue, and that will affect the way we do the calculation for the earnings per share when it comes to the weighted average number of equity shares. And we'll look at a question about that later on when we are solving some questions in that regard. Then there is also another extreme angle where the entity has maybe done a right issue, then they are reversing that. So they are doing repurchases of shares. So when an entity does a repurchase of shares, what happens then, or they've done a stock split and they are reversing that stock split, what happens is that the number of shares in issue will now be going to reduce, and there is a way we have to go about calculating the weighted average number of equity shares. So these are two extreme cases that the examiner could shower us in the exam hall, and we'll be looking at a question about these two later on when we are solving questions generally in respect of the accounting standards. But that is what you must understand when we talk about earnings per share. Any questions, you put it in the chat for me, and I'll provide you with some answers. Let's see if I have some questions coming up in my chat. What do I have? Sylvester said, following prof. Okay, thank you. What else do I have? Albert said, hi, happy new 2024 from Uganda. Many happy returns, Albert. Gerald said, reverse split or share split, how do we tackle it? Okay, so like I think I've made a comment on that already. And then how about ACCA prices? You can check for that on the ACCA website when you're doing your registration for the exam. What I shared was about the ICA examination for the March 2024 examination date. Okay, that's what I shared there. So any other questions for me in respect of this? Let's see. Okay, so basically that is the idea about IAS 33 earnings per share. So once you get the fundamental principles, now you can expose yourself to questions, and then based on the question, you can now know what I'm supposed to do. So make sure you read a question carefully. If it is basic earnings per share, which principle am I applying, and all of those things in that particular case. And that brings me to the end of earnings per share IAS 33. Like I said, now that we've got a fundamental, those two extreme issues that I spoke about a moment ago, we are going to be looking at them later on as we solve questions, because it's just based on these basic principles that we're just going to add a little extreme there. And when we are solving questions later on, we are going to be dealing with this particular thing. Give me a sec. Let me deal with something. I think there are some people who sometimes I don't understand what is going on in their brain, so they would like to spam comments and post some things that are not supposed to be posted everywhere. Okay. So let's block this person real quick. You don't come and market your nonsense under my post. I don't know who the heck you are. Okay, so I'm seeing another chat coming up. Let's see if I can handle that quickly. IT Solution said, Nhyira, please, when is the ICA new syllabus kicking off? And will there be a changes in level 3? The syllabus will be launched in on 29th of January. And so when the syllabus is launched, details about any changes will be discussed or will be communicated to you. As to when is it kicking off, the first examination for the new syllabus will be in November 2024. So that's the first examination. So the current syllabus, March 2024 is the last but one. And then July 2024 will be the last examination for the current syllabus. So the new syllabus will come in November 2024, which means that lectures from August 2024, because August, September, October. So lectures from August will be based on the new syllabus, because the exam for that will be in the November 2024. So that is the idea about that. Any issue about the syllabus structure, what subject, the changes and all that will be communicated. We'll discuss about it after the launch of the syllabus. There are some interesting things though that you have to know about, but don't worry, 29th is just here. So after they launch the syllabus, we are going to be coming on the stream and discussing with you the various changes and what you have to know about. And because the syllabus is being launched very early, that also helps to be able to assist students and other stakeholders to prepare well for the full implementation of the syllabus. So IT solutions, that is what I would say there in respect of your question. Okay, so that is the basic issue under IAS 33, and that brings me to the end of the discussion in respect of that. And I'm going to be wrapping up around here today, so that God willing, next week we're going to be starting with something else in the discussion. And remember, we are now in week 8 generally. So from next week, it's week 8. And if you check your calendar well, you realize that you're now going to have like 5 more weeks to go in that particular case. So you have to really raise the game if you want to prepare well for the examination and pass the examination. So thank you very much for joining the stream today. And like I said, in case you missed the part 1, part 2, you can check the channel, the podcast session on the channel, on YouTube certainly, the IFRS Masterclass podcast. You can check that playlist. And there are other playlists on the channel covering various videos, various topics. So from Monday, we're going to be continuing with something else. Updates about our live streams and various discussions are now going to be made available a lot of the time on our WhatsApp channel. So you can check the description of this video on YouTube and get a WhatsApp channel link. Click on that and then you can follow our WhatsApp channel, and then updates about our live streams, updates about everything that we're going to be doing will be communicated through the WhatsApp channel, and that is to help you to stay updated so you can join sessions and be able to know exactly what is going on in respect of your training and your studying, so you can prepare well for the examination and pass the exam. So that's it about that. Have a great weekend, and I'll catch you on Monday as we continue with our discussion. Stay safe and stay blessed.